Have you ever heard someone say, my mortgage company raised my payment for no reason? Or maybe you've heard, I thought my mortgage payment was fixed forever. Well, today we're going to talk about why those statements usually aren't true and why understanding escrow and property taxes can save you a lot of frustration as a homeowner. Welcome to Beyond the Rate, the show where we pull back the curtain on mortgages and make home ownership a lot less intimidating. I'm Kerri Worth, and I'm from Charter West Mortgage Center, and I am learning right alongside of you. Today, we're talking about two topics that create a ton of confusion: mortgage misconceptions and everything you need to know about escrow accounts and property taxes. So can each of you tell us who you are, introduce yourselves, and how long you've been helping homeowners?
I'm Laura Bailey with Charter West Bank, and I've been in the business for about 26 years.
Wow. Okay. Thank you. Dan?
I'm Dan Leathers. I've been with Charter for 2 years. I've been in mortgage for about 15.
Okay.
I'm Kerri Waugh, and I have been in mortgage for 8 years. So
Okay.
kind of still a newbie.
Kind of still a newbie, but you know everything.
Yeah,
already,
sure.
Right? Yeah, exactly.
If not, I have great resources.
You do. Yes, you do with Charter West for sure. So kicking things off, we're going to discuss some of the biggest mortgage misconceptions. I'd like to hear your take on each of those. So the first myth of these is you need 20% down. I think we all know that's not the case, right? So where did this myth come from? Anybody have an idea?
So it's actually didn't used to be a myth. In the 1930s, after the Great Depression, banks did require 20% down because they went through so many foreclosures. In the mid-50s, mortgage insurance companies came along, which helped the banks cover that 20% with insurance. So after the 1950s, 20% down has no longer been required. It's just a myth passed down from grandparents to kids.
Right. Yeah, kind of scaring them out of doing the home mortgage thing, right? Yep. Okay. So how much do buyers actually need to put down today?
Sometimes zero.
Yeah.
Charter West has several different loan programs. Your VA does not require down payment. Your rural development, and in my area, that there's quite a bit of that. But then with working along with the NIFA program, you can borrow for that down payment. So there's tons of options. You just have to have the right mortgage advisor who's willing to take the time to find the way for you.
Yeah, for sure. So, Laura, what loan programs exist for low down payments? You kind of went into that a little bit. So we know VA. What about like FHA conventional? What are those looking like?
Yeah, so on a conventional loan, they'd be looking at like a 3% minimum down payment. And then on FHA, 3.5%. Now, there are great programs offered out there that we partner with NIFA that they allow us to offer 5% more the purchase price to help cover that 3 or 3.5% down payment and cover most of the closing cost.
Nice.
Yeah. And then in addition to that, there are some grant programs out there too, such as the Federal Home Loan Bank of Topeka, that also helps with that down payment assistance.
Nice. That's so nice to have options as a potential homeowner, right? And especially first-time home buyers who are really scared of the process. There's just a lot of options for them that exist, it sounds like. Okay, so myth number 2, you need perfect credit. What credit score do people usually think they need?
I hear people saying they think they need over 700 for a credit score to get a loan. We actually have programs that you can go down to a 580 credit score as long as your problems are in the past and you're working towards rebuilding a credit score.
Okay. All right. So 700 is not the case. We can actually go a little bit lower. So what do lenders actually look at instead of credit score? You kind of mentioned a little bit like making sure that they're getting over some of those hiccups maybe they had in the past. But is there anything else that they look at as well?
I think your debt to income ratio is also a factor in there. And I mean, it's just in the file overall. It's the strength of the file overall, several different pieces that our underwriters look at. And we have in-house underwriters that are phenomenal with those lower credit scores. I just shoot that file over to the underwriter and have them take a preview of it just to make sure that they can't foresee issues that we might run into.
Okay. All right.
Yeah. I'll just add that.
Yeah, for sure.
Like with NIFA, there is a minimum credit score requirement of a 640 to use those additional down payment assistance programs. But otherwise, Kerri had mentioned, just our phenomenal underwriting staff that we can work closely with them. And let's say somebody has a lower credit score and they might have a lot of reserves. A lot of times we can still approve them. It just really depends on the overall strength of the file.
Right.
And
Okay.
not just the credit score.
So there's a lot of factors that
Mhm.
can go into it, not just credit score.
Yep.
Myth number 3, you should always wait for rates to drop. So we're dealing with some rate stuff right now, obviously. So why can waiting sometimes cost more?
So what happens when rates drop is more buyers enter the market.
Mm-hmm.
So there's more competition for a house, which usually means the house is going to go for over asking price because people are going to get into a bidding war on the house. So buying a house at a higher rate lets you get the house cheaper. And then when rates drop, you just refinance.
Yeah. Okay. So what factors matter beyond interest rates? Anything else that you want to add? There's a lot of factors, right? Like, where do I start?
Well, the longer that you wait, houses are typically also appreciating. So
Mhm.
now is really the best time to buy.
Always.
And then as far as the interest rates go, I mean, the credit score plays into it. Like you said, there are so many factors, but one of the things that I always, as I'm working with my customers is, the rate is what it is right now, but I always make sure that they understand, what are those steps as far as, what does it look like to refinance and what are those steps? So they understand that this is not a rate that they're locked into for the life of the loan. They can potentially get out of it into a lower rate down the road.
That's so nice.
One thing that I bring attention to with my first-time home buyers, especially if they're renting, if they're really getting hung up on that interest rate, it's like, well, if you're renting, you're currently paying the 100% interest because you will never see that money again. And so even if you're paying a little higher interest rate, it's an investment. That property is going to appreciate, and you'll never see that money back in a rental.
Yeah. Okay. That's another myth, is renting is always cheaper, and that's just not the case, right?
Correct.
Yeah, you're really just losing that money as you're putting it towards your payment. Next myth here, getting pre-qualified hurts your credit. How does mortgage shopping affect credit? I mean, is that something that I should be worried about if I'm reaching out to you and getting pre-qualified? Is that going to ding my credit?
So I think that the misconception there is because, when we do that credit pull, it's gonna hit that credit score a little bit. The thing to remember is that if you're shopping if that credit is pulled within the 30-day time period, because they want you to be able to shop, you're only going to get that hit once.
Okay.
And so that is kind of one of the things that I tell my borrowers to kind of ease that fear. And there's no time like the present. Don't let that ding of the credit score hinder you. And also, one of the tools that we have is that if your credit's not quite there, we can take a look at that credit score and run it, or that credit report, and run it through a scenario to where we can say, these are the things that you need to do to help improve that credit score to maybe get you into a better buying position. That's why we're the mortgage advisors. We're not just a loan officer.
Right. Yeah. So there's a lot of, like we keep saying, there's a lot of alternatives, a lot of options. So if you're scared of getting into a house, it's really wise to talk to somebody. And getting pre-qualified, I mean, you have to do it, right? So you're going to inevitably have that little ding on the front end, but it makes your offer so much stronger, right? When you're looking at homes. Okay. So those myths are always good to clear up, but now let's move to a topic that creates confusion for first-time buyers and experienced homeowners alike. So what exactly is an escrow account?
The best way that I have found to describe the escrow account is that it's the savings account that's built within your mortgage. And so it is going to pay out those property taxes and the homeowner's insurance on your behalf. Each month in your payment, you're paying for 1/12 of the homeowner's insurance and 1/12 of the property taxes to make sure that that account is constantly funded, so that there's enough funds in there to pay out those items when they come due.
Right.
And the nice thing is you don't have to worry about making it to the courthouse on time to get those property taxes paid. They won't go delinquent. And then, I mean, it's a warm and fuzzy for us too, because we don't want that property to be delinquent in either item, the homeowner's insurance or the property taxes.
Right.
One thing that I encourage my borrowers to do is on the anniversary, a month before the anniversary of that home purchase, is to shop that homeowner's insurance and make sure that you know what is going to be pulled out of that escrow account so that you're not caught off guard.
Yeah, because sometimes even if you don't have an escrow account, I mean, you could get hit with a huge payment that you just weren't expecting. And if you're not saving, I mean, you've got to come up with that money, right, at the last minute. Is escrow mandatory?
No.
Mm-mm.
And so if borrowers are putting down 20% or more on a conventional loan, an escrow account is not required to be set up. On government loans, it is a requirement to be on the loan,
Okay.
having an escrow.
Okay. So I just want to discuss a couple topics. Let's talk about property taxes. Just tell me a little bit about how those work.
Property taxes are fees assessed by state, county, and local governments that help fund schools, road repairs, fire stations. So you're paying in as a homeowner to help the community, and help yourself by keeping your roads and the schools funded.
Right.
But that's what property taxes all go towards.
Okay. All right. How about homeowners insurance? What is that?
It's the insurance to protect your property. That way, if there's any damage from storms or anything like that, and it depends on the policy of what will be covered in that. So it's important that you shop around for that homeowner's insurance. Find an agent who will walk you through all of the finer details of what the coverage covers. But it protects our investment as the lender as well as the home that you're living in.
Okay.
I actually had a client call yesterday because she wanted to talk about a refi because May 16th, there were some storms that went through northwest of Kearney. They lost half of their roof. They had water throughout the house.
Oh, goodness.
The house all the electrical has to be replaced in the house. Half the house has to be rebuilt.
Wow.
And they're out of their house for 6 months. Thankfully, they got a great homeowner's insurance policy, and the homeowner's insurance is paying for them to live elsewhere where their house is being rebuilt.
Right. So it's really important. I mean, it's mandatory, right? You have to have homeowners insurance. But again, not every policy covers everything. Like in some cases, flood insurance might be necessary, but it's not necessary for everybody. Fires, just any kind of damage, right, that can come to the house. Okay. So property taxes explained. We kind of went into that a little bit. Actually, I skipped something. Let's go back a little bit. Mortgage insurance. I think that's confusing for people. That's an additional payment on top of your principal and interest. Who wants to explain what mortgage insurance is?
So mortgage insurance is an extra insurance that the lender requires if an individual is not putting 20% down. And so on a conventional loan, that additional mortgage insurance is required until that 20%. And when there's 20% equity built up, then a borrower can request to have that mortgage insurance canceled from their payment.
Okay.
Otherwise, it automatically cancels, when they have 22% equity. So really, it's an additional protection to the lender in the case that borrowers are not paying on their mortgage. It's an insurance fund that can be tapped into to help cover foreclosure expense and such. So just gives a little bit of a warm fuzzy for us lending more with people putting less down.
Yep. Okay. That makes sense. So we talked about what property taxes are. We talked about who determines property taxes. Does the lender have anything to do with property taxes?
Unfortunately, no.
Okay.
And as a lender and a homeowner, I'm susceptible to property taxes at the increase too. It all depends on like the change of property taxes depend what they call the mill rate. So like when communities want to build new schools, they want to build new fire stations. This all takes into account. Comes into play on their property taxes, but the lender has no say in changes to that at all.
Okay. So does an appraisal have anything to do with property taxes?
No,
it doesn't. Okay.
Yeah, unless that appraisal is done for the bank's purpose and the borrower, so they know that the home that they're either purchasing or refinancing, really determining that value, but that really stays in the lender's file. That's not anything that we would ever give to the county that they would do any kind of that would factor into their assessment and then in turn impact taxes.
Okay.
So,
how often are taxes reassessed? It varies
Property
What's-
taxes are assessed yearly. I mean, reassessed yearly. The
yearly. Annually.
cities,
Okay.
counties, states do their budget, and from their budget, they determine a mill rate for each property on how much the property's taxed.
Okay. Okay. So with property taxes, with escrow, with any of that stuff, with homeowners insurance, sometimes the mortgage payment goes up, right? So, or it can go down. Is that right? Right? That's very
Rare.
optimistic of you.
In theory.
It's not very likely that your property taxes are going to go down, unfortunately.
Okay.
But if you are shopping that homeowner's insurance, you do have an opportunity to save money. But I caution that also because you want to make sure that when you're shopping those policies, make sure that you're comparing apples to apples. You might want to save some money, but in the long run, it really might not. If you have a storm that comes through and has damage, like Dan's client, I'm sure that they're really glad that they had the policy that they do. So
Sure.
what might save you a couple bucks month to month might cost you horrifically in the long run.
Okay. So we know now, even if you have a fixed rate mortgage, that can be affected. That can change just based on taxes, based on insurance, that kind of thing. Let's talk a little bit about the difference between principal and interest versus the total payment. Can you guys kind of explain how that works?
So each month, you're paying in on that principal and interest, and that principal and interest portion of that payment can never change. What does change is how much is being applied to the interest and how much is being applied to the principal. At the beginning of paying off that loan, you're paying a lot more in interest than what you are on principal. One of the conversations that I have with my borrower is if you make one extra payment a year, they estimate and make it towards the principal because that principal is equity in your home. Anytime you're making extra payment towards that principal payment, it's like putting money in your own pocket because you are building more equity into that home. They estimate that if you make one extra payment a year, you can knock 7 years off of that loan just by what you're saving
Wow.
in interest.
Okay.
And so when you purchase that home, it's the best investment that you can make. There's some great investment companies out there that you can, build a 401k or investment accounts like that. But your home is one of the best investments that you can invest in. So even making
Sure.
extra on that principal payment can save you a ton of money. And that's another conversation that when we talk about interest rates, we get hung up on what that interest rate is locked in at. But there's other ways to save money.
Okay. So we talked about principal and interest. We're going to go back to escrow a little bit. So you've got principal and interest, you've got your escrow account, and your escrow account is your taxes, your homeowner's insurance. So that's what's making up your payment, right? So is there ever a situation when an escrow shortage happens? You're all laughing.
I mean, honestly, for most homeowners, the escrow shortage is yearly.
Okay.
I mean, homeowners insurance tends to go up some every year. Some years it's bigger increases than others.
Okay.
Unfortunately, we all know property taxes typically don't go down. We have in Nebraska the last couple of years seen a decrease in property taxes with the new governor, and but unfortunately those years we had bad storms, so homeowners insurance went up enough to make up the
Regardless.
So no, typically you don't get an overage, but if you do, yearly your bank will analyze your escrow account, and if you have an overage, they will refund the overage to you because they're only allowed to keep so much in the escrow account. They can't keep extra money in it.
Oh, okay. So nice little bonus in some cases. Probably doesn't happen very often though, right? Yeah. Okay. So it's important to point out that if there is an escrow shortage, it doesn't mean the lender made a mistake, right? So don't come back to your lender and say, "What did you do to me?" It's a case of homeowners insurance raising. It's a case of property taxes raising and that reassessment every year, right?
Right.
Yeah.
There's another big or situation that has it'll every single time. So if somebody is purchasing a new home, then when they buy that new home, the taxes are typically based on a lot only. And then when we close, we're collecting for the actual taxes, which are maybe a minimal amount. And so, eventually when we can increase their payment to collect for the higher amount of taxes, that's a huge hit. And so we
Yeah.
always have make sure that we drive home the point, especially at closing, that, hey, your taxes
taxes.
are going to go up, your
Yes.
payment will go up, and that will definitely cause a shortage, and how to plan for it.
Okay. All right. So just to kind of repeat a little bit, so it sounds like there's an escrow analysis that happens every year. Is that kind of that reassessment every year that we're talking about?
Mm-hmm.
Yeah. Okay. So we know why a lender performs an escrow analysis. We want to make sure you have enough money in there. Anything that homeowners should know about that? I mean, should they just be planning to put aside some money regardless, because they should just plan for the cost to go up?
I mean, typically you will find out what your property taxes are changing at the end of the year. Typically, I think most counties send out a new tax bill at the end of the year to let you know what your taxes are going to be.
Mm-hmm.
So you need to look at that, because if your property taxes are going to go up, $500, you need to be prepared for the fact that when your bank does the escrow analysis, that they're going to need $500 more of your funds to cover those property taxes. So there are ways for the borrower to kind of be prepared. They'll get their homeowners insurance renewal usually about a month prior. And then, like I said, they get their property taxes at the end of the year. Most banks, I think, run their escrow analysis in spring, summertime.
Mm-hmm.
So they have a few months for property tax to prepare for that.
Okay. All right. So let's see. Some things they can do to avoid surprises. You just kind of mentioned that. So reading your annual escrow statements, budgeting for tax increases, reviewing insurance premiums annually, asking questions early, and just understanding local tax assessments. So pay attention, right? Yeah, just keep that top of mind for sure. So we're going to do kind of a rapid fire escrow question round. So these are some questions you already answered, but I think if we can answer these very succinctly and shortly, people can kind of get just a really good idea, kind of a reiteration of what we talked about. So what is escrow?
Escrow is the savings account that's built within your mortgage.
Okay. Is escrow the same as closing costs?
No.
No.
Closing costs is paying for the loan,
Mhm.
like processing on the appraisal, all the title work, where the escrow account is strictly a savings account for taxes and insurance.
Gotcha. Can I remove escrow later?
Yes, on a conventional loan with 20% equity.
Nice. Okay. What happens if taxes increase?
Your payment's going to go up.
Going up. Okay. Insurance increases. Same thing.
Same thing.
Same thing. Okay. If my escrow account has extra money?
When they run that escrow analysis, they will refund that extra money to you.
Okay. And can I pay property taxes myself?
You can,
But do you want to?
but you do not want to.
Okay.
I've actually had a client do this too, and then it took him about a year for the county to get it straight, where he had paid his property taxes and then the bank sent in property taxes. It really, really causes problems for you.
Yeah. So trust your escrow account.
Trust your escrow.
Okay. All right. Any of you have any stories where a homeowner maybe was shocked by a payment increase and like what was actually happening? I think Dan does.
Well, it kind of goes back to what Laura said with the new construction. No matter how many times we tell them, sometimes people don't listen. And,
Yeah.
they build a new house, a $750,000 house. They're being taxed on a $60,000 lot. Well, the next year the house goes to $400,000, taxes quadruple.
Mm-hmm.
And they're just not ready for that.
Yeah.
Like, they have not put the money aside.
Right. So
Yeah.
it's just really important to understand that that's going to happen.
Yes.
Yeah.
The good thing is your lender qualifies you for your final payment. So when your house is assessed. So it's really important as a borrower to look at that and know what your payment potentially is going to, so that you are prepared for that.
Yeah, for sure.
And in those situations too, I always recommend to my borrowers, we give them that estimated tax, that higher tax amount. Say, just put this in your own savings account. And then what happens is once that escrow analysis is done, then you have that lump sum of money just sitting in your escrow account. Plus you're already accustomed to paying that higher payment. And then, so once the bank starts to collect it, then it kind of evens out at that point.
Right. Okay. That's smart. Any other lessons that you guys have to share with our listeners about escrow and taxes? Nothing particularly. Okay. Well, we're going to wrap it up. That was quick and easy, right? Yeah. Okay. So if there's one thing that I hope listeners take away from today, it's this. Most mortgage surprises aren't actually surprises. They're things that may have not been explained clearly in some cases, but maybe there's a situation where, it's just listening and understanding and making sure that you're asking the appropriate questions. So understanding escrow, property taxes, and how your payment is calculated can make you a much more confident homeowner. So thanks for joining us today on Beyond the Rate. If you have questions you'd like us to cover in a future episode, you can send those our way. And we'll see you next time. Charter West Bank, member FDIC, equal housing lender.